Light is Britain's far-right conspiracy theory paper spreading hate and vicious lies. No, that's what the BBC say. The Light is the only national newspaper bringing you the real news and informed opinion on what's really going on today. You can subscribe, order copies, submit articles, and read back issues on our website, thelightpaper.co.uk, and see for yourself why the establishment are so worried about the uncensored truth getting out to people every month. The Light Paper. Not far right, just right so far. thelightpaper.co.uk.
Scene script. Have you ever pondered the idea of financial independence and early retirement? The notion of not having to clock in at 9 or wrestle with the daily grind? Imagine a life where you're not shackled by financial obligations or a demanding job. It's not an impossible dream, but a reality for those who embrace the FIRE movement. That's financial independence, retire early. Consider the tale of Jane, a woman in her early 30s. Jane was an ordinary person living an ordinary life. She had a 9-to-5 job, a mortgage, car payments, and a lifestyle that was comfortable but hardly extravagant. And like most people, she dreamed of a life where she didn't have to worry about money. Jane decided to make a change. She began by cutting back on non-essential expenses, saving as much of her income as possible. She invested wisely, focusing on assets that generated passive income that didn't require her to trade time for money. Slowly but surely, Jane began to build her financial independence. She was still working, but she was no longer living paycheck to paycheck. She had a safety net, a cushion that gave her the freedom to make choices based on what she wanted, not what she needed. Fast forward 10 years, Jane, now in her early 40s, had achieved her goal. She was financially independent. She had enough passive income to cover her living expenses, and she no longer needed to work to survive. She was free to retire early, to spend her time as she pleased. Jane's story may seem extraordinary, but it's not unique. It's the story of anyone who has embraced the principles of the FIRE movement. It's a tale of discipline, of sacrifice, and of a relentless pursuit of financial independence. To summarize, the key points discussed today revolve around the idea of financial independence and early retirement. It requires discipline and sacrifice, cutting back on non-essential expenses and saving as much as possible. It involves investing wisely, focusing on assets that generate passive income. But most importantly, it requires a change in mindset. It's about seeing money not as a means to buy things, but as a tool to buy freedom. It's about understanding the true value of time and the freedom that comes with not having to trade it for money. This is the essence of the FIRE movement. It's not just about retiring early, it's about achieving financial independence, about gaining the freedom to live life on your own terms. Like Jane, you too can embrace the principles of the FIRE movement and embark on a journey towards financial independence and early retirement. After all, the only thing standing between you and your financial freedom is you.
Ever wondered how much you'd need to save to achieve financial independence? The answer lies within the mathematics of a concept known as FIRE, which stands for Financial Independence, Retire Early. The most essential number in your journey to financial independence is calculated by multiplying your annual spend by 25. Notice the emphasis on annual spend, not annual income. This calculation is based on the principle that you need £300 invested for every pound you wish to spend each month in passive income. Hence, your FIRE number is also your monthly spend times 300. This mathematical principle is founded on the 4% safe withdrawal rate, as defined by financial advisor William Bengen. He proposed this rate after analyzing the S&P 500, which typically produces an average of better than 10% growth per year when studied over a period of approximately 30 years. Bengen considered factors such as inflation and market volatility. After studying previous market activity, he concluded that a 4% rate of withdrawal per year would provide for a 30-year sustainable portfolio in the vast majority of cases. So to paint a clearer picture, if your monthly spend is £1,000, then your target for financial independence is 300 times 1,000, or or £300,000. Alternatively, if your annual spend is £12,000, your financial independence target is 25 times 12,000, which also equates to £300,000. The first step in planning your financial independence, therefore, lies in understanding your monthly and yearly expenditure. Without this knowledge, it is impossible to take further strides towards your financial freedom. In summary, the mathematics of FIRE revolves around the principle of multiplying your annual spend by 25 or your monthly spend by 300 based on the 4% safe withdrawal rate. Knowing your monthly and annual spend is crucial in determining the amount you need to save to achieve financial independence. Armed with this knowledge, you can then plan your journey towards financial freedom. Remember, the journey to financial independence is not a sprint, but a marathon. Embrace the mathematics of FIRE and take the first step towards your financial independence today.
Good morning, guys. It is 7:59 on Monday the 11th of November. Today actually will be a bank holiday throughout Europe because of Armistice Day. Obviously in the UK we had Remembrance Sunday yesterday, but in Europe they stick to the actual date itself, the 11th of November. I hadn't actually anticipated that, but it'll not affect things significantly for us. So far we have completed 2 years and I think 32 weeks in this, what will be roughly an 8-year financial independence journey. And if we look down at the statistics here for the 52-week range and the days range above it for Friday, you can see that the market hit its all-time high at market close, I think 88.03. Yeah, it's still at that point, so 88.03 at close on Friday. My suspicion is that that's likely to pull back this morning, because that represented a rise on the day of 1%, which is quite a lot. It would be a surprise to see that maintained, although look at that, a further jump just as the market opened there, 1.5, back to 0.5%, on market open. I suspect it maybe take a few minutes for things to settle down, but on the whole it looks as if the market is happy with the way things are looking at present. You can see that the high point has increased down here, as you would expect, given that jump just now. Pardon me. Let's have a look at the notifications. Trump media up 25% after Trump states he has no intention of selling shares. Biggest stocks before earnings: Monday.com, Gold Ship Lease, Liquidia, I think that's ICI Group, but I'm not sure, and Aramark. Tesla up 7.2%, reaching $1 trillion valuation as it continues its post-election rally. I suppose if you think about it, the US election result was good for Trump, and because Musk was very attached to the Trump campaign, then it was good for Tesla as well. I'm not sure if SpaceX has been included in that rise, but it'll be interesting to see. Sony pops 11% on booming profit growth, driven by gaming and imaging units. Airbnb down 8% as investors digest profit decline in the third quarter. Doximity surges 36% as Q2 results top Wall Street expectations. Pinterest down 12% in response to underwhelming Q4 revenue guidance. And finally, Vistry down 20% after issuing its second profit warning in a month. I'm actually surprised not to see a mention here about, maybe it'll be further down, something about holidays and the European markets being closed today, because I'm pretty sure they will be. The UK market is certainly open, because that's where I'm invested, and if it wasn't, you wouldn't have seen it jump as it did there. So currently things sitting at 88.47, up 0.5%. The current portfolio value is 21,150, and we have 239 shares, and the average purchase price currently sitting at 68.28. And we'll go ahead with the investment right after this.
I want a bank that makes money easy.
That sounds perfectly reasonable.
And you are?
We're a bank called Monzo.
I want a bank that shows me what I spend instantly.
No problem, just give us a go. See?
Can you make splitting bills easy?
Super easy, check this out.
But it's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on.
Can I talk to a real person 24/7?
Of course.
Even now?
Yep.
Even now?
Anytime.
Can you tell me when I'm running a little low on cash?
We certainly can.
Cool. Can I afford these?
You certainly can't, sorry. Can't afford that either.
That's a real shame.
Not really. Time's up, how'd you get on?
It's a draw.
Can you help me save for my next holiday?
Oh, how about you set up a savings pot in the Monzo app called Barbados, baby?
Thanks for listening, Monzo.
We're all ears.
We can go now.
Rude. You make Monzo Monzo.
Okay, Monzo is the bank that I use as my primary current account. I also use it to fund my Trading 212 platform, portfolio, and I find it very, very easy to use. I find it very user friendly. The app is nice and straightforward. Transfers happen instantaneously. Things like weekends and bank holidays don't get in your way. Transfers just go whenever they're supposed to. And I like it. I like it for that reason. I've also set up a Monzo for Kids account with one of my younger kids, so that she can have a bit of financial freedom to a certain extent, although I can see all the detail of all the spending and all that sort of thing as well. But the Monzo for Kids comes with a contactless card, chip and pin, and it's completely customizable. For example, you can turn off the ability to make purchases online, which I've done. And there's the ability to also do things like block the card, and for instance, my daughter can choose to block her card from her phone if she loses it, and if it turns up half an hour later, not a problem, she can just unblock it again. So it's really, really user friendly, quite straightforward, and I don't know why anybody wouldn't want one. If you do use the affiliate link, which is in the description, if you fund your account and if you make a purchase within the first, 30 days, then we will both get a £5. which would be very nice in the run up to Christmas. Yeah, so no, absolutely no shame in promoting Monzo. With that said, guys, let's go ahead and buy our weekly £120 worth of shares in the S&P 500 exchange traded fund, shown here as the Vanguard variety. Given the increases in price that there have been recently, rather than being able to buy 1.4 shares, we're now down to 1.3.5. Let's send it through as a market buy. Now, just before I do, let me remind you, 68.28 is the current average purchase price. I'm expecting that to go to 68.38. That's usually the way it seems to go. So let's send it through. It has executed. We got 1.35 for 88.47. And the average purchase price has gone to 68.39. So actually a slightly greater increase than what I expected in that. But I suppose the market has increased quite a bit in value, so no big surprise. So the figures have updated. We now own 240 shares, almost 240 and a half. Current portfolio value 21,269, and as you can see, the current market value is sitting around about £88, just shy of 50p. It'll not be long until we cross the £90 barrier. I'm not sure if that's a psychological barrier for some people or not. But quite honestly, given that this is valued in pounds and pence, there's a real possibility that it could be dragged over that barrier by the holdings in dollars, because obviously the two don't correspond. I don't think there's anything else really to say about that for today, other than we are at the highest point we have seen to date in terms of price. Given that that's the case, I think it's not unreasonable to expect a bit of a pullback. But with that said, I think that, as I say, is everything for today. I'm going to just say thank you if you have been watching. Hopefully you find this useful and entertaining. And, you know, at the end of the day, this, although it's supposed to be an experiment, I'll put that in air quotes, really it seems to me as though the experiment is proving the FIRE methodology. I mean, if we take a look at that view, sorry, I need to put that back again. Okay, so I've just flipped things around so that we're looking at this view of the market, and if you can see the smaller grey line, which is roughly where the mouse is tracking, that is the investment in the market. Now this is looking at a 1 year time frame, and the blue less regular line is the portfolio value for the past year, and as you can see, the gap between the two is increasing. Okay, so basically what will happen at some point is that at some point there will be such a difference between the portfolio value and the amount invested that even whenever the market crashes, it'll not come below the point of the value invested. It will crash, it'll be worth less, but it'll not actually be worth less than the amount that was put in. And as time goes on, that gap should increase in size. And of course, remember that as time goes on, as dividends are paid and that sort of thing, if they're reinvested, that also increases the gap. Now, it is my belief that we don't actually have dividends in the practice account, so that in itself isn't going to play a role, but nevertheless, you can see, just looking at that, how well the portfolio is escaping the invested amount. Anyway, sorry, that was just a little interlude. As I say, if you're interested in investing, if you find this of interest, why not subscribe to the channel? And if you particularly liked this one, why not give it a thumbs up? And other than that, all that remains for me is to wish you a good end to your Monday, and to remind you that I'll be back again next week with more. Thanks for watching in the meantime.